There is a $6,000 deduction sitting on your tax return right now. After 2028, it's just gone. And it drives me crazy because almost nobody is talking about it. Look at this couple. Both 67, $880,000 sitting in pre-tax retirement accounts. They're going to pay over $2,600 more in federal taxes every single conversion year. Not because they made a mistake, not because they chose the wrong accounts, but because nobody sat them down and showed them this window existed before it closed. That's $216 a month walking out the door. Over a 20-year retirement, that is $52,000 in taxes they handed over that they did not have to pay. Today, I'm going to show you exactly how this deduction works, the catch inside it that's costing people thousands, and why the tax deadline everyone keeps screaming about is actually dead. I'm Helena. I break down retirement tax strategy using actual math, not headlines. If you want the real numbers, hit subscribe. For years, you've heard it. Convert your IRA before 2026. Tax brackets are going up. You're running out of time. Forget it. That deadline is dead. When Congress passed the One Big Beautiful Bill Act, they wiped out the 2026 expiration on the lower tax brackets. The 12%, 22%, and 24% rates no longer have an automatic sunset under current law. So if you heard the Roth conversion window closed and quietly moved on, stop. You did not miss it. But here's the thing. There is still a deadline. It just has nothing to do with tax rates. And almost nobody is talking about it yet. It's called the Enhanced Deduction for Seniors. You might also hear it called the Senior Bonus Deduction. And before I explain the catch, I want you to understand what it's actually worth in real money. $6,000 per eligible person. Reducing the taxable income calculated from your pension, your IRA distributions, your 401k withdrawals, the taxable portion of your Social Security. Every one of them, whether you itemize or take the standard deduction. Married filing jointly, both spouses eligible? That's up to $12,000. Just sitting there. It covers 2025, 2026, 2027, and 2028. After that, no gentle phase out, no gradual reduction. It's just gone, unless Congress acts again. Most people who qualify for this have never heard of it. They're running their conversion math with an incomplete picture, and the gap is costing them real money. Not because they did anything wrong, but because nobody sat them down and showed them the full picture before the window started closing. Let me walk through this so you can verify every number yourself. Single filer, age 67, one income source, $25,000 from a fully taxable pension. You convert $50,000 from your traditional IRA. Assume the full amount is taxable. Total income, $75,000. Your 2026 deductions, $16,100, basic standard deduction, $2,050 additional deduction for being 65 or older, $6,000 enhanced senior deduction. Total, $24,150. Taxable income, $50,850. Federal tax, approximately $5,900 for the year. Now do the identical conversion after the deduction expires. Same pension, same $50,000 conversion, same brackets. The $6,000 is just gone. Taxable income rises to $56,850. Federal tax, approximately $7,200. That is $1,300 more per year for the exact same income and the exact same conversion. That is $108 a month straight out of your pocket in a year where you did nothing differently. Over 20 years of retirement, at that rate, that is $26,000. That is a car. That is a year of travel. Gone. From one deduction expiring on one conversion in 1 year. Scale that to a married couple where both spouses qualify. They lose up to $12,000 in combined deductions when this expires. At a 22% marginal rate, that's $2,640 more in federal tax per conversion year. That's $220 a month. Across 3 years of planned conversions on a large pre-tax IRA before required distributions begin, that is $7,920 in extra federal taxes they did not have to pay. And that does not count the tax-free growth those converted dollars generate inside the Roth for the rest of their lives. That is real money. and it walks out the door one conversion year at a time. I know what some of you are thinking right now. My RMDs don't start until I'm 75. I have time. I'll get to this later. This is where people get hurt. Under Secure 2.0, required minimum distributions don't start at 73 for everyone. Born 1951 to 1958, age 73. Born 1960 or later, age 75. Born in 1959, Treasury has proposed age 73 due to a drafting overlap in the law, worth confirming with your tax advisor. Most people hear more time and relax. Stay with me here, because this is the part that costs them. This deduction does not care when your RMDs start. It expires after 2028, regardless of when you were born. Whether your distributions begin at 73 or 75, you have 3 conversion years left on this deduction: 2026, 2027, 2028. The cheapest years to do your Roth conversions aren't the years right before your RMDs begin. They are right now. Here's the catch. And this is where the standard advice you hear on YouTube is going to cost some people thousands of dollars in 2026. Most people who know about Roth conversions have heard it. Fill the bracket. Convert up to the top of your current tax bracket every year. That advice sounds right. And it drives me crazy, because if you follow it without understanding one specific thing, you will accidentally erase the very deduction you were trying to use. A Roth conversion generally increases your MAGI, your modified adjusted gross income. Say your base income is $60,000 and you convert $50,000. Your MAGI is now $110,000. As a single filer, the enhanced deduction for seniors starts phasing out above $75,000 of MAGI. At $110,000, you are $35,000 over that threshold. The deduction is reduced by 6% of that excess. $35,000 times 6% is $2,100. You just accidentally erased $2,100 of the deduction you were trying to use while you were trying to use it. That is $462 in extra federal tax at a 22% marginal rate. That is $38 a month. From a phase-out, most people doing this right now have never heard of. You converted to protect your retirement. And the conversion itself triggered the penalty. And that is not even the worst part. Stay with me here, because this one sneaks up on everyone. Medicare uses your tax return from 2 years ago to set your premiums. A conversion you do in 2026 directly affects what you pay for Medicare in 2028. It's called IRMA, the Medicare Income Surcharge. I know what you're thinking. The threshold is high. I probably won't get close to it. Let me show you why that's the wrong assumption. IRMA for 2026 kicks in above $109,000 for a single filer, above $218,000 for a married couple. These thresholds adjust annually, so the exact figures for 2028 won't be set until closer to that year. But here's what nobody warns you about clearly enough. IRMA is not a sliding scale at the bottom. It is a cliff. $1 over the threshold, $1, triggers the full surcharge. Your Part B premium jumps from $202.90 a month to $284.10 a month. That is $974 more per year for Part B alone. That is $81 a month. IRMA can also stack on your Part D drug coverage on top of that. A retiree who converts $1,000 more than they needed to can trigger nearly $1,000 in additional Medicare costs 2 years from now, from a decision made this afternoon. And when that bill arrives in 2028, they will not connect it to a 2026 conversion. They will think Medicare just got more expensive. That is how real money leaves without a trace, not dramatically, quietly, through one miscalculation that echoes across years. Before you convert a single dollar, you or your CPA need to map your income against the senior deduction phase-out and the IRMA limit separately. Going over the line might still make sense for your long-term plan. It might still be the better lifetime tax decision. But it needs to be a choice you made on purpose, not a surprise you get in the mail in 2028. Look at this couple again, both 67. $600,000 rollover IRA, $280,000 traditional 401k, $880,000 total, $20,000 a year from a taxable pension. No Social Security yet. Wide open bracket space. They know about Roth conversions. They've been meaning to look into it. They wait. With modest growth over 6 years, that balance reaches roughly $1.1 million by age 73. Their first required minimum distribution, using the age 73 divisor of 26.5, is approximately $41,500 per year. That is $3,458 a month coming out of a pre-tax account, landing on top of their pension and Social Security on the IRS's schedule, not theirs. Those distributions keep rising if the balance keeps growing, and they can push more of their Social Security into taxable income while they're at it. They had a window. It was wide open for 3 years, and it closed while they were meaning to look into it. Now run the version where they acted. $60,000 converted per year. 2026, 2027, 2028. $180,000 moved into a Roth, full amount taxable each year. Their deductions, $32,200 joint standard deduction, $3,300 in age-based additions, $12,000 enhanced senior deduction, $47,500 total. With $80,000 of combined income each year, taxable income is approximately $32,500. Federal tax, roughly $3,400 per year. The total federal tax for all 3 conversion years was about $10,200. State taxes apply separately depending on where you live. $10,200. That is the price of admission. That is what they paid to move $180,000 into a Roth, with no lifetime RMDs for the original owner and qualified withdrawals that may be received completely tax-free for the rest of their lives. In exchange, they carry a lower pre-tax balance, a smaller first RMD, reduced Social Security taxation exposure, and lower IRMA risk going forward. The couple who waited, they are paying $41,500 a year in forced distributions on the IRS's timeline. That gap compounds for as long as they live. The difference between those two outcomes is not income. It is not intelligence. It is not even access to a financial advisor. It is whether someone showed them the actual numbers before the window closed. Look, here is exactly what you do with this. First, pull your most recent tax return. Line 15 is your taxable income. That tells you your current bracket and how much room you have before the next one. Second, before you convert a single dollar, map your projected MAGI against 2 separate limits, the senior deduction phase-out threshold and the Medicare IRMA cliff. Run both. Going over either line may still be the right call for your long-term plan, but it needs to be a choice you made on purpose, not a surprise you get in the mail in 2028. Third, contact your custodian or plan administrator. Ask about conversion eligibility, required paperwork, withholding options, and their year-end processing deadline. Then sit with a tax professional before December 31st. Roth conversions must be completed within the calendar year. Once it closes, that year is gone. And completed conversions generally cannot be reversed. 2026, 2027, 2028. 3 years. Up to $6,000 per person. Up to $12,000 per couple. A deduction that lowers the real money cost of every conversion you do while it's open. And after 2028, it's just gone. The people who use this window are going to carry smaller required distributions, lower Medicare exposure, and tax-free savings for the rest of their lives. The people who wait are going to pay more on the exact same money. The only difference is the year they took action. You know which year you're in. Don't waste it. If this helped, you see the actual math. Hit like. It puts this in front of more people while the window is still open. Next week, I'm breaking down the one number on your account statement that determines exactly how much the IRS forces you to withdraw every year during RMDs. Most people have never looked at it. Now that you understand this conversion window, that number directly affects how much is left to protect. Subscribe and turn on the bell so you don't miss it. Drop a comment below. How old are you, and have you started converting yet? If you haven't, what's the one thing holding you back? I read every single one. The most common situations become future videos. I'm Helena. I'll see you in the next one.